This video is an ultimate guide of everything you need to know as a first-time home buyer, as well as all the top tips and tricks that I've learned over the years. So over the past couple of years, I've helped buy and sell my parents' old home. I've helped them set up a positive cash flow for their house. In addition, I've also bought a condo, a new build in Toronto. I did not use a real estate agent to buy any of my homes as well as condos. So you know that this video will be completely unbiased and just me giving you the best tips and tricks possible. Without further ado, let's get started. These are the essential steps that I think you require to buy the home. So number one, planning your money. Number two, market research. Number three, finding a home that you like. Number four, submitting your offer. Number five, going through all the conditions, inspection, financing, etc. Step six, lawyer reviews everything. And finally, the closing date in terms of handing off your keys. So the first part, planning your money. In most cases, I would say in general for beginners, you need to have at least 20% for the down payment. Now, I know that there are some cases in the States or depending on the country that you live in. For example, in Canada, we also have CMHC insurance. And basically the idea there is that you can purchase insurance. Because of that, your down payment will be less. For example, with CMHC, for your first 500K, it will only be 5% down payment. However, I think for a beginner, as a general rule of thumb, you should have at least 20% saved up for unknown costs, things like that. And first thing that I would recommend to any beginner at the start is go and get a mortgage approval with a specific bank. And I know some people recommend that you talk to some mortgage broker, things like that, but they'll have people there, they'll tell you the exact steps that you need to get financing, and they'll tell you exactly the budget that you'll have in terms of the house that you want to buy. In order to do that, they're going to ask you to give them a couple of documents. For example, they'll ask you to give them proof of income over the last 3 months. They'll ask you if you've been at the same job for the last 2 years. Typically, they want you to have like 2 years of work experience at the company that you're in, things like that, so they know that you have a stable income. And typically, currently, I think the mortgage that they give you in terms of the loan is about 4 to 5 times your salary. So let's say you're making 100K a year, they might give you around 400K, 500K as a loan. Now, I know that in the past when the economy was doing quite well, maybe they'll give you 6, 7x. So this will fluctuate depending on how the economy is doing and how much the bank is willing to lend to you. So in addition to that, they'll also do a credit check to make sure that your credit check history is okay. And after all of that, they'll give you a maximum number in terms of the amount of mortgage you can get based on a 20% down payment. Now, of course, you can make it more complicated by saying that what if I purchase insurance? What if I only pay 5% only for the house? Things like that, and they'll give you a different amount depending on that. But in general, I think at the start, it's best to keep it really simple and have them give you the maximum amount based on 20% down payment mark. It's going to be different for various countries depending on the city that you live in. But something that is important to note is that if you do have student loans, if you do have car payments that are loans, then those will eat up on that mortgage amount that they'll give you. But it's only after they give you this mortgage approval that you can figure out, this is how much I can spend potentially on a house. I know I didn't want to talk too much on what housing mortgages are, but I'll go through briefly what in terms of Canada they do. So in Canada, if you want to pay less than 20%, you can use CMHC mortgage. And basically, it's essentially like a mortgage insurance that they give you so that you pay less. So that just means that if for some reason you default and you can't pay off the house, the mortgage insurance will cover it for you. And because of that, you can pay less for it. So in terms of Canada, I won't go too in detail on the numbers, but basically, if you're making a 5% to 10% down payment, then there's a 4% insurance premium. So the example that they give you here is let's say you have a purchase price of 500K, you make a 10% down payment, the amount of mortgage that you have is 450,000, then the CMHC total cost will be around 14K for the duration of a home mortgage. So that's actually, in my opinion, is not that much because as you can imagine, let's say you have a 25-year loan, that 14K will get distributed monthly throughout that entire yearly loan. So your payment will maybe just be like, $50 to $100. So it's not gonna be as significant as you think, but it is something to be aware of. Now, something to note is that a lot of these insurances are for your first home only. Now, if you buy a second home, most of the time they'll ask you to pay a more significant down payment, such as 20%, 25%. So this can only be used one time for essentially allowing you to get into the market as a first-time home buyer. I know this is kind of different depending on the city, the country that you live in. The way I typically think about it is instead of telling you essentially how much money you should be saving and the amount of money you should be thinking about, I I encourage you to think about the amount of risks that you're willing to take. So, for example, on the extreme end, the people who do this in terms of like home flippers, the people who do this as a job, who figure out housing projects, they're able to take investments and hard money loans that don't come from the bank. And the risk there is that their interest rate is really high and taking a lot of risk because you're taking loans that perhaps the house doesn't profit, you might not be able to pay back, things like that, and your monthly payments might be super, super high because they're hard money loans. For example, I've heard hard money loans have like interest rates of like 10-15%, which is like double the amount that banks will usually give you. But this is not really relevant for first-time home buyers because most of the time you'll just get to the loan from your bank. And the reason that home flippers can do this, or people who do construction projects or are doing something for positive cash flow renters, they can do this, is because they're confident that their project can profit. They are calculating all of the numbers. They can figure out what their carrying costs are for the house if they're planning to flip the house. They can figure out how much rent that they're getting so that they're confident that they can get positive cash flow, even if they are borrowing this amount from hard money loans or from friends and family. So that's something on the extreme end, which is potentially extremely risky if you don't know what you're doing. Now, some people take sort of more medium extreme risk in which they only pay 5% with CMHC. Now, I wouldn't say that that's extremely risky in and of itself if you're only paying 5% with CMHC if you do have savings. You have to be aware that there are other costs, and if you're only paying 5%, your mortgage is potentially a lot higher. You have to pay the mortgage, insurance loans, you might have an increased interest payment. So yes, you are paying only 5%, but you have to think about the fact that you are paying more on a monthly basis. Now, on the medium term, you could for sure max out on your mortgage amount. For example, let's say the bank says you can borrow 500K and you do borrow the 500K, but you make the 20% payment. Now, the general rule of thumb that people sometimes say is don't let it exceed 50%. Some people go on the lower end, like 25%, 33%, things like that. I think people have different philosophies on the amount of money they're willing to pay in terms of proportion to the income that they actually have in terms of housing costs. But now, a lot of people do save the 20% for the down payment, but they're not aware of the fact that there might be property tax costs, which are typically like 5% of the total home value for a lot of cities. There are some provincial costs that I will go into detail later that you have to think about. There might also be estate costs if you live in the US. There are lawyer fees, there's realtor fees. There are a bunch of fees in addition to the down payment that you need to pay for the home. And typically people say like, you need to budget about 5 to 10% in addition to the 20% down payment that are just like costs to close the home, to get the home. So having significantly over 20% I think would be the safe thing to do if you don't know what you're doing at the start. Cool. Let's move on to why you should buy a home. So I would say that for most people, when they first buy a home, they think that they might need the extra space. They think that this is something they need to purchase a home for their family, things like that. But one important thing in terms of investment is that it is a leveraged investment. And the super simple example that I like to give is, let's say you invest 100K, which is 20%, 120K, it's a 20% payment for a 600K home. And let's say your home is now worth 650,000. So it's easier to turn 600K into 650K than to just invest 100K and try to get 150% increase on that amount. So that's why housing is such a powerful investment, because you're sort of getting a leveraged loan and getting a leveraged investment there. Now, if you're super, super rich, I know billionaires, for example, I'm super into soccer, so the people who bought Manchester United, they got like huge loan from the bank to buy the actual soccer team. Like, a lot of people, my point is that a lot of people use these bank loans in order to get a greater return on their investment. So in terms of that, buying a house could be a potentially very beneficial investment for you because of this idea of using leverage. Now, some other people prefer not to rent and they think it'd be more convenient to buy a home. I don't really understand that, because as a home, you might have to, if there's issues, you have to deal with that. But as a renter, you don't have to deal with that as much. Now, there are issues, for example, if you're a renter, that you might have to move out if the owner wants to move back in. I'm actually dealing with that issue currently, or other potential issues with renting a home that is sort of more convenient if you were to buy instead. So it really depends on what your thought process in terms of why you want to buy the home. But I encourage you to think very carefully of what your budget is and sort of what the main decision making and motivation is to buy the home. Because I don't think it will be potentially less work than you think, because there's actually a lot that goes into buying a home and also maintaining all of the costs. Cool. So I'm gonna skip over step 2 until the end of the video, because it's super complicated and it can be very intricate in terms of the market research that you want to do. There are experts that go into this to make a profit for homes. But for now, I will just go into the basics of finding a home that you like. So a lot of people browse through websites like Realtor, Zillow, Redfin, etc. There's tons of websites that have listings. Basically, they just take from the MLS database, which is essentially the database of all homes that are currently being sold or have been sold, and they apply it onto their website front end. And basically from there, you can look at all the new listings, you can look at price reduced houses, you can look at open houses, you can get the numbers of the realtor agents, and you can figure out which houses, which communities that you're really interested in. So most people start there and browse through these websites. And a lot of people do have realtor agents, and realtor agents will, if you like a place, they'll also help you find potential houses, and they will also help you schedule viewings of houses that you like from these websites. So you can either go to the open houses yourself, you can have realtors help you find homes from the communities you want to live in, or you can even schedule the viewings yourself by calling the realtor agent directly on this website. A lot of these realtor websites, they'll have the realtor agent contact information, and you can actually book the viewings yourself if you want. So that would be the place where I would start. Now, I'm a question that gets asked, and I didn't use a real estate agent. A lot of people say, like, do you really, or a lot of people ask, do you need a real estate agent? I don't think there is a cookie cutter response to that, but let me give you costs of a realtor so that you get an idea of what you would be paying. So in Canada, at least, the typical combined real estate commission of fees for both the buyer and seller agent is 7% for the first 100K of the home price and 3% for the remaining balance above 100,000. It's usually split 50-50 between the buyer and the seller's agents. Now, realtors will typically tell you that when you buy a home, you don't need to pay any of the fees because the fees are built into the home price. But think about it. The person who's selling the home has to think about the fees that they have to pay to the buying and the selling realtor. So you're technically paying for it anyways. So if you do the math quickly, let's just say you bought a $300,000 home, 7,000 of it would be the first 100K, 18,000 for another rest of the 600K. So essentially you have 25,000 of realtor fees that the seller is not getting. They're giving to the realtors. So if you think about it in that terms, 25K is just going to the realtors. That's not going to the seller that you're essentially paying for as the buyer. And I've typically used this as a negotiation tactic. For example, if I tell the buying realtor directly that I'm not using the selling realtor, I'm going to say, like, cut half of that 25,000. Give me the 12.5K savings that you're not going to have to pay the selling realtor. So for me, at least, I think there's benefits in terms of having better ways to negotiate if you don't have a buying realtor, because you can say that, you know what, you can save that buying realtor fee cost. In addition to that, I feel like sometimes the transactions that you have to do, a lot of it can be handled by the lawyer, a lot of it can be handled by your home inspection, things like that, because I do think that 25K in the beginning when you pay for the home, maybe in the long term is not going to be that big of a deal, but it is a significant amount that you should be thinking about. Cool. Another way that you can have the benefit of realtors without having to pay a significant amount is you can actually use online realtors. This is a website, Property Guys. I think it's pretty popular. There's some other websites as well. Basically, you have like online realtor. They'll set up all the staging, all the photography. If you're selling a house, they'll do all that for you. And if you want a buying realtor, they can also set up like viewings for you, things like that, help you draft out the offer. They essentially do everything that a realtor would do, but perhaps don't have sort of as much time one-on-one with them to talk about communities, for them to give you advice about like viewings, things like that. But they essentially handle it from end to end in terms of like doing the listing, doing the staging, doing the imaging if you're like selling a house, and buying a home, giving you recommendations of communities, giving offers, things like that. So this is another option. And the reason why some people go with this option is it's significantly cheaper. I think some of their packages are a couple $1,000s. I didn't use these specifically because I didn't use a realtor, but I don't think the costs go over 10K. It's a couple $1,000s and they'll do all the setup, including all the imaging for you. So I think that's also a pretty good deal and a pretty good alternative. So the reason I bring up this graphic, which is it says new interactive website that shows prices for homes sold in Metro Vancouver. Now, it doesn't matter which city you live in. Pretty much most of the real estate boards, they have some type of like monopoly on the MLS database listings. So they, as a realtor, they can see listings in terms of houses sold over the past 30 days. They can look at historical data. They can even look at the home that you're interested in and see how many times it's been sold, things like that. But you can't, or at least it's not easy to find that information for you as a prospective buyer. And I don't think that's good. I think honestly, it should just be public information available to any buyer. It seems like they just have like stranglehold on this. And this website is an example of where there was, I think, some type of like hold by Vancouver or BC real estate board where you couldn't show MLS sold prices, but then a website ended up showing this, and then it went to court, and the court was like, oh, it's fine, like you can't have a monopoly on this. So I think it is being broken down, but my point is that even at this point, it's very difficult for you to get a sense of like historical prices, things like that, because there is such a big monopoly from whatever real estate board or city that you live in. And I suppose you could say that that is a competitive advantage with going with a realtor, because they can see the purchase history on the LMLS for your specific house. They can see all the documents. They can see all of the houses that were sold nearby and how much they sold for, how many bedrooms they had, things like that. They can literally help you in terms of making these historical price comparisons, which you can do as well, but it is significantly more difficult for you because you have to look online to find this information, and it's not publicly available because you don't get access to the MLS database. Now, there's obviously some other pros, like examples. For example, if realtors have sold in that area, they have experience over the community, things like that. They maybe have sold many homes around the city, so they have an idea of the type of home that you might need. And I've actually noticed this as well. If you don't have a buying realtor, sometimes the selling realtor will just refuse letting you view the home. Now, I just want to bring up the fact that you sometimes might get deprioritized. I have literally called selling realtors being like, can I view the home? And they're like, do you have a buying realtor? If you don't have a buying realtor, I'm not going to schedule a viewing with you. Now, most of the time that's not the case, but it's just something to keep in mind that this might be something that occurs if you don't go with a realtor. In addition to that, most real estate boards, most provinces, most states, they have their own standard template for giving an offer, giving a purchase offer to the owner. And for some reason, they don't give you access to this. You have to be a realtor for them to give you the contract forms. Now, there are ways to find them online so that you can write the contract yourself. But if you are lazy and you don't want to do that, a realtor will write that contract for you. And it's a pretty standard contract. Basically, the template does everything for you, except for the conditions that you have for the offer, which I will show you in a bit. It's a standard offer template. It's pretty similar to like you're renting a home and you had to like fill out some rental application, but you don't have access to the form because whatever realtor board doesn't allow you to have that form. Super strange to me. I mean, it's not strange to me. I know why they're doing it, but these are just things that you have to be aware of when you're thinking of using a realtor or not. We move on to submitting the offer, because you might be curious about what steps you need to take if you do like a home. So assuming that you have gone through this process, you have taken the time to find a home that you like, and you want to submit an offer, what typically happens? So again, this is not publicly downloadable, but you are able to find it online. I found this online in terms of, this is like Ontario, in Toronto, they have like this is their standard purchase agreement for a home. And yeah, basically it's all really standard stuff. They list the buyer's name, they list the seller's name, they list the property address, you have your purchase price, deposit, what the schedule is in terms of deposit, things like that. And then you put in your conditions and what you require, and then you also put in the final closing. So literally, for me at least, when I sold and also bought my parents' home, I literally just filled out all of this myself. And a lot of times, if the selling realtor is nice, they will help you do this. And like, okay, I think the slides are a little bit mixed up here, but going into offer details, the key things to note are typically the buyer is going to want you to submit a deposit. And the reason for that is that once you submit an offer and they accept, they can't take any new offers from other people. But because you're locked into this contract, they want to have some confidence that you will have an ability to close. So typically they'll ask for a deposit of around 5%. Now that can change. In some of the homes that I bought, the deposit was lower. But after that, you have to specify your conditions as the buyer. So what's pretty standard in Canada, I think it's the case in the US as well, is basically you have 2 weeks to confirm financing. So this is when you go back to the bank and confirm that everything is all good. You can get all of the mortgage that you need. In addition to that, within the 2 weeks, you do a home inspection. You might even have a lawyer review. And then there are also sometimes conditions where, for example, for my parents, they had to sell their home and it was contingent on them to sell their current home, before they can buy the new home. So you can add conditions like that as well. It does become more complicated because there's some timing issues between you selling your current home and then buying the next home, but you can add all of that in the conditions. So the idea of having the deposit and having these 2 weeks is, if for whatever reason the lawyer reviews it and they don't like it, or if there's a house inspection and they don't like what's going on, or if you get financed, or if you get rejected for financing from the bank for whatever reason, you can get that 5% back. But once all the conditions have gone through and you've waived all the conditions and you're saying we're good to continue the contract, you can still withdraw and you can still reject the contract even before closing date, before you get the official home, but you will lose your deposit. So there will be situations. There's been situations where some homes, like, they went to the final closing date, and because for whatever reason the buyer got cold feet and they didn't want to buy the home, they just cancel the contract, and the seller still has to own the home, but you won't get your deposit back. So that's just something important to know. Within those 2 weeks is for you to think about everything, make sure everything is good, and if you don't like the home, you can always still get your deposit back during that time. And in addition to the offer, you'll have things like the final walkthrough. For example, right before you get the home, you have like maybe 3 days beforehand, you have a final walkthrough of the home, make sure all of the conditions have been met, everything is looking good. Between this time when you were setting everything up, getting the offer accepted, that they didn't like the home or do something crazy. So there's the final walkthrough, and then you have final closing date. And one other important thing to note about offers is that typically you give them like 24 hours expiry date. So this is important because let's say you really like this home and you're worried that somebody else might be coming in with a different offer, right? If you can get them to sign within those 24 hours, then you have the right within those 2 weeks to figure out if you're gonna buy the home or not. So this is something that most realtors will help you do, but that you can set up yourself as well. So these are some images of my home inspection when we did them for my parents' new home. For example, for the home inspector, they'll do thermal scans to make sure everything is good there. I think they did thermal scans at different places, different walls to make sure there was nothing abnormal. They're also gonna check the outside, they're gonna go on the roof, they're gonna check if all of the outlet boxes are okay. For example, this one was broken and they recommended that we replace this. So this is something that we went back to the seller and told them, you have to replace this for us. It's also stuff like, for example, for us at least, the garage door wasn't opening and the seller had to fix that as well. So during this home inspection, it's actually very, very, very important because they'll tell you everything that's not working for this home that you're looking to buy. So I would always recommend try to find the most reputable, the best home inspection professionals at your particular location, because this will help you negotiate in your contract. You can go back to your seller and say, these things don't work, you have to get these fixed, or give us a discount on the price. So you can always use this as a way to renegotiate some of the pricing or ask them to do certain things and add some new conditions. All right, so one word of advice in terms of the inspection is if you do decide to do something different that wasn't previously in the contract before, make sure to add that in the contract. We've had scenarios where, for example, when I was buying a new home for my parents, they even said in the contract that all of the furniture would be negotiable to be left to us. And then by the closing date, they were like, oh, we actually need to take all of this new furniture because it's like, we want to take it back. And because on the writing, it didn't specify which furniture was like negotiable, they could just take it. So what I'm saying is, it's like, if it's not on paper, if it's not on the contract that they're gonna fix something or do something, then they might not do it. Make sure to get everything on paper and documented. Cool. So after you've done inspection, you also have to go through the financing conditions. So this is where the bank looks at the house and like, everything is good to go. Your previous approval is still at the rate that they recommended for you. For example, the interest rates have not changed. Typically, when they lock you into a approval in terms of the amount, mortgage loan amount that they get, they also lock you in on an interest rate. So if the interest rates have gotten better, you can renegotiate the interest rate. But if the interest rates have gotten worse, you've already locked onto an interest rate that you think works for you. So when you talk to the banks, they will help you to double check that everything is okay. Also, sometimes for new builds or for new homes, they might actually go into the home and try to appraise the price. So this is just to make sure that the purchase price that you're paying for is actually what they expect from the value. And the reason that they do that and appraise the price of the home is, let's just say you can't pay the home and you default on your mortgage. House is collateral, and they want to make sure that the house value is actually what is being suggested. So that's why you can't have situations where, let's say the house is only worth like 500,000, but then the deal with you and the seller is like something like 1 million. Now, obviously there's going to be some discrepancy in terms of the value and things like that, but it's not going to be that big of a discrepancy because sometimes they will do an appraisal if they see something strange like that. And then some of the final conditions are with regards to lawyer review. Now, some people say that you don't really need to do a lawyer review until the very end where they give you a transfer of the land title, which means essentially you are now the official owner of the home. But on Reddit, I was like doing some scrolling back in the day and they were saying how like, oh, some of the smart buyers, they have a lawyer do a review before they even make an offer. I don't know if that's actually the case. I don't think it's actually essential to do that. I do think you should pay the money to get a really good lawyer because they're going to review everything. They're going to review the conditions. They're going to figure out like everything with the home, like make sure everything's okay, that they have the land title and transfer the land title with you, set up all of the property reports, things like that. So I think a lawyer is very valuable and very important. But I'm not sure you need to do it when you give the initial offer. That's because, again, you have that 2-week buffer to figure all of those things out, make sure that the home is what you want. So you can do that during the 2 weeks, I think no problem. I think it's better, in my opinion, to give the offer, make sure you have the home locked down for those 2 weeks so you can figure out if you want it, especially in a market where it's like super hot and there's other people who are interested. Final closing date, you get all the keys, you get your mailbox keys, you get everything, and you're pretty much good to go. And in terms of the property tax, you pretty much have to pay for that specific year. Even if you, like, for example, got a house in like January or something, you have to pay for that prior year. So that's also something to be aware of as well. That's why I always say that it's gonna cost more than you think. There's gonna be property taxes that you have to pay for. There's gonna be like random other fees that you have to pay for. And I'll show you later on for one of the condos that I purchased on all the random fees that I didn't really know prior to paying for this condo that you have to be aware of. So these are all the basic steps that you need to know. Now I'm going to go into sort of more complicated details of sort of the market research that you can do. So this is complicated because there are people who make money in real estate. There are people who do tons of market research to figure things out to make sure they're getting a profit. I don't think it's necessary for a beginner, but I still think it's important to cover because it helps you understand and give you a broad strategy of what you're going for, what your market is like, and what type of home that you want, and sort of what the prospective potential profit, things like that for your home is gonna be. Okay, I think one of the key questions that you need to ask for your city is your city a growth market or is it a cash flow market? I kind of usually think about this in terms of like stocks. Some stocks are growth stocks, some stocks are dividend stocks. And basically, for a growth market, you make the money based on the appreciation of your home. A perfect example I can give for this is in terms of Vancouver. Like Vancouver, the houses are super expensive, but they're also rising really quickly. So you're making money based on the fact that you believe that in a couple of years, your house is gonna increase in price. Now, typically for smaller cities, their house prices are not going to change as drastically in comparison to a place like Vancouver, New York, Toronto, these types of bigger cities. That's why they're considered more so of a cash flow market. What I mean by a cash flow market is that a lot of times you buy this house to own, you might be able to get a bigger house, but if you want to buy this house for rental income, things like that, it's a good cash flow market because the rental home subtracted by all the fees, mortgage, property tax, maintenance, is gonna be you're gonna get positive cash flow from that. That's really hard to achieve in a big city like or Vancouver, things like that, because the original price of the home is already so high. I can give an example of this. Now you might think that the rents in New York or like for example in Vancouver are super high already. But let's say you bought like a 1-bedroom condo for $600K, which is already very standard for like a pretty basic 1-bedroom condo. Your mortgage at a 5% interest rate is already going to be 100. Now I know during like COVID or pre-COVID, like your interest rate could be like 1-2%, and you could get positive cash flow even in like a bigger city, because you could rent this apartment, this 1-bedroom for like maybe $2,500, something like that. But in today's world, where the interest rate is well over 3%, you're not going to positive cash flow on this. There's just no way. Like you doing this in a larger city, you're like as a rental property, you're just not going to cash flow. You're betting more so on the fact that this condo in a couple of years is going to be $700K, $800K, and you want to make money this way, especially as an investor. Now, let's contrast this to in Calgary. In Calgary, most of the like 2-story homes, things like that, the average median price for the longest time was below $600K. So you could very well get a 3-bedroom house with a basement that's already developed with 1 bedroom for around $600K. And it's the same price as that 1-bedroom condo in Vancouver. The mortgage is just going to be $480K if you're paying 20% with the 5% interest rate, $2,800. And if you rent the home entirely, you still might not be able to positively cash flow just because the interest rate has been so high recently, but it's going to be higher. And if you rent the room separately, you can definitely cash flow positive. Now, this is something that sort of I did for my parents to sort of lower the mortgage rate. We bought a home where we rented out the basement, and it gave us like sort of a significant decrease in terms of the mortgage. But as you can imagine, if you just rented the entire home separately, you could actually positively cash flow in a smaller city. Now, for the people who don't know where Calgary is like the Houston of Canada. So, and Vancouver would probably be like New York or something, or LA, depending on how. I think Vancouver prices are probably even more expensive than Los Angeles or New York. But my point being is that you can positively cash flow in your community, but you have to know if your market is a cash flow market or a growth market. Now, this condo, maybe in a couple of years, is going to be way more expensive than the house in Calgary. So I don't think there's a right answer to that. So that's something you have to decide. So some cities have geographic constraints. Like New York City, everyone wants to be in this like small series of islands there, but the natural boundaries limit the ability to expand in the city. That's why the housing prices are going to be really high. That's why it's a growth market. People want to be in New York, but they don't have space. So the houses are going to increase in price there no matter what. West of Vancouver is the ocean. You can only expand east in Vancouver. So there's a geographic constraint there because you can't expand on one side of the city. Working professionals are going to Toronto, and Vancouver, maybe it's for lifestyle, they're going to Vancouver. So just by looking at these geographic constraints, you can tell that these are growth markets. An example of this is just looking at the trend. So this is, you'll see something similar for Vancouver. This is just like the average home price in Toronto over the past like 30 years. And you can just see this exponential increase in these big cities. Now, this is in contrast with Calgary, where there is a reasonable increase in terms of the price. You can see in the early 2005, the price was increasing significantly, but it's much more variable. So this is what you get for a $2.4 million home in Vancouver. This is what you get for a $2.7 million home in Calgary. Just complete difference. This you could probably for 2.7 million you could get like a really nice mansion. You could like literally live in one of the best community Calgary. So it's just very different. I also have some general housing principles that I think are important to know. So I think when the economy is doing well, I mean, most people know this. People try to move to the big cities like New York further their career because the economy is doing well. People are hiring a lot. People migrate closer to their jobs. A lot of areas in the city center, the prices are increasing a lot. Now, when the economy is doing poorly in the past couple of years, people try to migrate farther away. So typically, you will see a recession and you will see a price decrease in the city center of these big cities. But because people are moving farther away, you'll actually see the communities farther away start to catch up in price to sort of the central communities in the city. That's actually something that you observe in Calgary as well, because one option is to move farther away from Toronto. Another option is just to move to a different city entirely. Because of this, Calgary, Houston, these more affordable cities are getting new people moving in there. One thing that you can research that will actually help increase the value of your home is to figure out the transit. If there's new transit being built, figure out if there is an Apple, a Starbucks, a Whole Foods, a Costco near where you live. Because the logic that at least I'm thinking here is that if Apple, if Starbucks, if Whole Foods, if Costco, if they're willing to build a new store there, if they're willing to build something there, then there is potential. They probably think that that community is a growing community and they think that there is potential to invest there. In addition, if they're gonna build like a new subway station, or they're gonna build a new train station, new bus routes there, then the government must think that like this community is gonna be really important going forward. And if you're close to a train line, your house price is gonna increase because it just makes it more desirable because the transportation is better. So these are some things that I think about in terms of potential future plans or potential increases to your house price. I did want to talk a little bit about increased in fees. So when I was doing this new build, as you can see, like the fees were absolutely ridiculous. There were like property taxes, developer caps, warranties, things like that. So my point being is like for a new build or for like a new house, things like that, or even for an old house, you have like transfer taxes, things like that. There's gonna be additional fees. So you should budget for the down payment. But when I first started doing this, like I wasn't aware of all of these fees that had to be taken into consideration. So yeah, these are just things that you need to be aware of. Make sure that you budget for these things in case you have not. So this leads me to the idea of like sort of housing categories. Houses, condos, and condos, they do increase on sort of a similar trend, but if you look at their graphs, sometimes they behave differently. And this is just because for different cities, people the people who buy condos, people who buy houses, or just the demographic is different. Like, something to note is that condos have HOA, condos have condo fees. Those fees are significant. When I was younger, I always wanted to live in a condo where it had like a gym, had all the amenities, had, bowling alley, had a pool, things like that. But the first thing that people told me about buying condos is don't buy a condo with a pool, because maintenance costs for pools are so high. So like, your condo fees are not fixed. Basically, if the building needs to do some maintenance project, you have to pay for that. Like, the condo fees for you are going to increase. Nowadays, if you have a pool, like, you could certainly be towards the $400, $500 a month for condo fees alone that you have to pay every single month, which is insane. As a beginner, I would just say avoid new builds, because new builds are good, but if you look at Toronto recently, they've had a huge crisis with new builds, and you're paying a premium for a new build. Like, new builds are going to be more expensive than the condos around or the houses that are currently around. So you're paying to speculate on the fact that in a couple of years from now, that those new builds are going to match that value. So I just have a couple other things that I want to quickly mention. So for starting your search, one way that you can make it really simple for yourself is you can set up email notifications for houses at the budget that you want. For example, one thing that I searched for on realtor.com was to search out for walkout basements. That's something that I really wanted, below like $1 million, things like that. I was also searching for 2-bedroom apartments. I also had a friend who built a software to help them do it automatically to figure out a community price and then just like give them a notification if like some house is below the average of that community price. So it can be as simple or as complicated as you want. But to start, you can just set up email notifications on realtor.com. You can do that super simply, and it will just send you an email whenever there's a house in a community that you want at the price range that you're looking for. Final thing that people talk about a lot is buyer versus seller markets, and it's super simple. They make it sound so complicated, but it's not that complicated. They just take the inventory currently. For example, maybe there's like 1,000 homes being sold in your city, and then they divide it by how many homes are being bought over the past month. So like, for example, like anything 2 or lower is usually a seller's market, because if you have 1,000 homes coming onto the market and then 1,000 go away on that month, that means it only has 1 month of inventory, right? So it's a seller's market because there's a lot of buyers who are looking for homes and there's not enough homes for it to go around. Now, when it gets to a higher range from like 4 or higher, I think some people say 5 or higher, then the market is typically considered to be in buyer's territory. So that means there's a lot of inventory out there, but not enough buyers. So between 2 to 4 is considered more so as balanced. And why this is important is because during a seller's market, the seller gets to pick like who they accept their offer from, right? And you can't put in as many conditions as you would typically want to do, because they have so many offers that they can pick between. This is in contrast to a buyer's market where like sellers like maybe desperate to sell their home, but they can't find a buyer. And in addition to that, most of the time, buyer's market can also have some seasonality. Most people try to buy homes in the summer, but the issue with that is there's a lot of activity in the summer and people are looking to buy in the summer, but there is a possibility that you have a lot of competition in the summer. Okay, final slide, pro tips and tricks. So if a house has been on the market for over 30 days or something significant, there's probably something wrong there, or like, the price is too high. Like, there's probably something that's causing it to not get sold. It's sometimes like a house goes out on that day and it goes within that week. So it's like if they reach the second, it's either because you are currently in a buyer's or there is something wrong that you need to be aware of. So that's something I always take a look at when I look at those like realtor websites. A lot of realtors, also selling realtors, they also implement the tactic of overpricing or underpricing a house. Let's just say a selling realtor talks to the owner and the owner is saying, I'm willing to sell the home for $530,000. Well, their price of the home, make it $499,000, because a lot of people, again, they use those search things, like anything under 500K, anything under like a certain price range. So it might attract viewers with an intention of buying at like a lower range, and it might a lot more people. And then they can just stack off and maybe sell at a higher price, and then maybe stack up to a 430K level. I see people do that in Vancouver a lot as well. Now, sometimes people are like, want to get to 530K, but we're not going to be able to get there because some of the offers people are giving are like undercutting the price, things like that. So at a higher offer, we attract less viewers, but we might get a viewer who thinks they're getting a good deal because they are putting the price lower than our offer price. So they might list it at 550,000, and then they have this buffer room to say, you know what, like anything between 530,000, 550,000, we're willing to accept. Now, this strategy is important to be aware of, because when you go to a place or when you see a property, you can tell right away if they're implementing the underpricing strategy or if they're implementing the overpricing strategy. Sometimes the realtor will even tell you. And then in addition to that, I know that I previously mentioned that the real estate boards typically have a monopoly on the MLS database for like price history, things like that. But people have started to make websites, people have started to make things that can show you the pricing history. Like for example, in BC, in British Columbia, in Vancouver, you can actually check the sale prices for similar properties in BC assessments. There's also a website called honestdoor that's really nice. And then there's also other websites in the States, I think Redfin, things like that, that can tell you the previous purchase price. So I think those things are going to be really important to help you understand, well, how much did the owner previously pay for it? What's their wiggle room? Because do they want to make some profit because they want to like give it to like, pay the realtor, things like that. They want to make some profit over the past couple of years, things like that. So like knowing the price history, having that data, I think will be really important, especially when you want to make an informed decision on like your community and the house that you want to get. Okay, cool. I hope this has been really useful, and I hope you guys learned something in terms of how to buy your first home, and good luck out there.